Welcome back to our series on accounting journal entries. We are going to dive into the world of journal entries and explore how they impact the financial statements. In particular, we'll discuss two business transactions involving company ABC and their October telephone bill. Let's get started. Transaction 1. Receiving the October telephone bill. On November 1st, company ABC received its October telephone bill totaling $1,000. However, they plan to pay the bill at a future date. So, how do we record this transaction in the journal? In the account column, we need to identify the accounts affected. In this case, we have the telephone expense account and the accounts payable account. The telephone expense account is debited with $1,000 because it is an expense and expenses increase with a debit entry. On the other hand, the accounts payable account is credited with $1,000 because it represents an amount owed to a vendor or supplier. Accounts payable increases with a credit entry. By recording this journal entry, we are essentially acknowledging the incurrence of the telephone expense, while also creating a liability in the form of an accounts payable. Let's now explore the impact of this transaction on the balance sheet and income statement. The balance sheet shows the financial position of a company at a specific point in time. The accounts payable, being a liability, is added to the liabilities section of the balance sheet, increasing the total liabilities by $1,000. This represents the amount owed by company ABC to the telephone vendor. Under the equity category, retained earnings decreases by $1,000 due to telephone expense incurred. On the income statement, we would see an increase in telephone expense by $1,000, and the net income decreases by $1,000, assuming there are no other transactions. Transaction 2. Paying the October telephone bill. Now, let's move on to the second transaction. Company ABC eventually pays the October telephone bill. How do we record this payment in the journal? We will again identify the accounts involved, which are cash and accounts payable. In this case, cash is credited with $1,000 because the company is reducing its cash balance by paying the bill. Accounts payable, being a liability, is debited with $1,000 since the company is decreasing the amount it owes. By recording this journal entry, we are recognizing the outflow of cash and reducing the liability of accounts payable. Finally, let's discuss the impact on the financial statements. On the balance sheet, under the assets category, the cash account is decreased by $1,000. This represents the payment of the telephone expense. The balance sheet will also show a decrease by $1,000 in the accounts payable account, under the liability category, since the company has fulfilled its obligation. On the income statement, there will be no impact since the payment does not affect the company's net income. That wraps up our lesson on journal entries for accrued expense and their impact on the income statement and balance sheet. I hope you found this explanation helpful.